Let's talk about how the industry will shape up over the course of the next 3 to 5 years after this initial spate of surge that we've seen in the listings and the investor appetite thereof. A veteran and MD and CEO of HDFC Life Insurance Company, Amitabh Chaudhry, joins in to talk about the sector and the company as a whole. Mr. Chaudhry, good having you. Thanks much for joining in. Now, the benign annual premium equivalent growth over the last few years probably provides a solid base for growth rates for the next 5 years at least. What about the medium term, say the next 15 years? Is it possible to look that far?
So if you look at the industry growth rate in the individual business over the last 4 years, it has actually been quite solid. We have been registering a growth of upwards of 15% year on year. The last year was very good at 24. This year, I think up to January, it is close to 31% for the private sector. So if you look at the private sector, it is 16, 14, 25 plus, and then 30 up to January of this year. And I know this is after, in spite of the fact that the demonetization happened last year and the growth rate has continued. So our belief is, and so is that of the industry, that the runway for growth is long and huge. I think the people are understanding the insurance products more. The kind of products which are being launched in the market are extremely competitive. The understanding of the customers has improved. And as some innovative products and niche products are launched in the marketplace, the growth scenario for the industry remains positive, and I do believe we should be able to register a growth of upwards of 15% going forward. You specifically asked about HDFC Life. We have been very consistent in what we have been saying, that we believe we have a unique platform in HDFC Life which should allow us to deliver a growth which is higher than that of the industry. What that number is very difficult to predict, and it will be a forward-looking statement, but our view is that we have the right platform to deliver a growth higher than that what the industry is delivering, which should be upwards of 15% year on year, at least for the next 5 to 7 years.
What about growth beyond 5 years? I mean, do factors change drastically after that, or are you refraining from commenting because it's difficult to preempt that?
Well, if you look at the macro picture, you look at the GDP growth rate, you look at the underpenetration of insurance in the overall market, you look at the financialization of savings, you look at how insurance can claim a rightful share, you look at the fact that the private sector is gaining market share at the cost of the incumbent LIC, you look at the fact that the top players in the private sector are gaining market share from the smaller players. Yes, I think you can say on a macro basis that the growth rate can last longer than 5 to 7 years. The reason I'm restricting myself to 5 to 7 is not because I don't believe in growth after that. I mean, beyond that it's very just difficult to justify that, no, come what may, will continue to grow at that rate. But as I said, if you just look at the protection market, there are various reports which suggest that as of 2014, the protection gap was $8.5 trillion of sum assured. India has reached a per capita GDP of less than $2,000. There is an inflection point at which people will start buying more and more of protection, and if that happens, just the protection market itself can give a fillip to growth, which perhaps has not been seen till now. Another way to look at it is, let's look at China. I mean, how big China is in comparison to India, and at what stage will India look like what China is today? Is it 5 years? Is it 10 years? Is it 15 years? Even if we reach that number in next 10 to 15 years, that itself should predict a pretty decent growth path. So there are a number of factors which seem to indicate that in the long term, the growth rate should remain positive and upwards of 15%. Now, within the industry, who is able to execute better, who is able to capitalize on this opportunity and grow at that rate or at a rate faster, obviously remains to be seen. And execution will remain the key, as is in any industry, even in this industry, and whoever executes well on a day-to-day basis, on a yearly basis, I think is the one who will benefit from this opportunity.
Okay, now, we all talk about how insurance is underpenetrated. There is an alternate view here. Outstanding life insurance about 250 million, and the total number of households about 250 million. Now, if we say that about 100 million households are insurable, then we have about 2 or 2.5 life insurance policies per house already. Is that a good metric to figure out how underpenetrated or penetrated the industry is? Or would you look at the conventional percentage of GDP, etc., to say that industry is indeed underpenetrated? What's a better yardstick?
So, it is a good parameter to look at as to how many policies are outstanding out there and compare it to the number of households. There are a couple of issues with this, just looking at this metrics alone. One is that we are assuming that the size of the policy or the transaction size of the policy is good enough to ensure that particular family or that particular member. They might have bought a policy, but it's of a very small amount, and so that does not take care of the requirements of that family. And that's why I said India is underprotected by a huge margin. And India is perhaps one of the most underprotected countries in the world today. Second point is that a lot of these policies, while people might have bought, a lot of them are in the lapsed status where they've paid one or two premiums, but they have stopped paying premiums beyond that. So they might be outstanding in the books of insurance companies, but they are not necessarily paying policies. So, we have to look at both. What is the average transaction size? Is it comparable to a very simple yardstick we use? Is the sum assured equal to 10 times the current income? So over a period of time, people should be buying more policies. Is it taking care of their pension requirements? And there are a couple of products. It's not just one insurance product people need to buy. You need to have something for, to manage or maintain your lifestyle post-retirement. You need to have something where if there is a sudden death, you can maintain your lifestyle. There are some savings products for the long term, etc., etc. So it's not just one product. So yes, it is a parameter worth looking at, but we have to look at some other parameters like, as you rightly mentioned, the insurance penetration as a percentage of GDP. What is the underprotected levels in the market? We talked about 92.5% is the protection gap in India as of 2014, and I don't think it has come down. Same with health. The amount of health insurance bought in India in comparison to the spend on health in India, there's still a huge gap, and it is only growing. It is not coming down. So when I say that the runway for growth is huge, it is based on some of these very parameters. And the gentleman who has pointed this out is pointing to a right number, but it needs to be you need to dig deeper in terms of one or two more levels to come to the conclusion that yes, India is today over-penetrated. The good news is that all these households have bought life insurance. So they have some experience. So it means that someone has reached them. We just need to ensure that they are appropriately covered and they're buying all the products they should from a savings perspective.
Are you seeing this a trend of the same customers that you already have upping the premiums? I know of a lot of people, including myself, who've now upped the term insurance premium that they pay. But what's your experience with your customers?
Well, as you see in any other financial business, a lot of the sales is happening to the same customers. But yes, new customers are always joining and buying products of the industry for the first time also. I don't have the number off the cuff for HDFC Life, but I would expect that number to be somewhere into the 50% range. We on an average are selling 10 lakh policies every year on the individual side, and I do believe that at least half of those customers are buying insurance at least from us for the first time. We also cover a lot of lives on the group side, and I believe a majority of them are actually buying insurance for the first time, at least from HDFC Life. So yes, new customers are entering the insurance space. As you very rightly pointed out, a lot of people realize that what they bought earlier is not good enough, and they're going and buying another policy because they realize that they were undercovered earlier, or they have now more money to invest in certain financial savings, and insurance is the only non-product out there. So it's a mix of both. All the insurance companies are trying to obviously increase their reach across India, either by setting up their own branches or by ensuring that they tie up with various bank insurance or other players who provide them that reach, because you obviously want to reach these customers at the lowest cost possible. So as insurance companies try to increase their reach, the depth and breadth of their coverage across India, we will end up reaching more and more new customers, at least for our company, if not the industry.
And what percentage of that reach will be for pure protection plans? Because there is an ideal mix which will lead to better profitability for all companies, including yourself.
So we do believe that this protection share, since you mentioned 11.8%, that's on an AP basis. I quoted on a received premium basis. Numbers are the same. It's a question of what matrix you use. Let's just take this 27.3% as a number which we are working off. We believe that if the protection market does not take off, if it remains where it is, and the growth is all incremental, there is no reason why this number can't be taken upwards of 30% in the next couple of years. And probably stabilize at that stage, because we obviously want to continue to grow other parts of our business. But if the protection market was to take off, then there's this number, because we are much, much bigger than the industry, this number can skyrocket to a much larger number. I don't want to speculate on that number, but I do believe that we are well positioned to capitalize on that growth or that takeoff as and when it happens, because we have the largest number of bank insurance relationships in the industry. We are pioneers in the online space. We have continued to engage with the aggregator side of the business very, very actively. Our brand is extremely well known. So as I said, our platform is in place. It's a question of how well we execute as and when the opportunity arises.
Okay. One question that the skeptics have is persistency ratios. Now, the 61-month persistency ratio isn't really over 50% for the industry at large. 13-month persistency sounds like too short-term a measure as well in a long-term industry. What are your thoughts here?
So let me first start by saying that the persistency number across the various cohorts, as high as it can get, is good for the company and good for the customer. Now the reason why, and the 13th month number has to be high for a 60th month number has to be high. Because ultimately it's the same set of policies which are working their way through the 13th month, the 25th, the 37th and 48th. And whatever is falling off is going to reduce your 60th month number. And why should we stop at the 61st month? We should go on to the 17th, the 3rd month and so on. Yes, I do believe the industry should be aiming for a persistency number on the 13th month, which is upwards of 85% at a minimum. And then I'll try to reach a 90+% number over a period of time. If you can get that number right, and because of the 5-year lock-in, chances are that your 61st month number also will automatically gradually move up. The fact that today our 61st month number is 48%, it is reflecting our 13th month persistency of the policies which we sold almost 5 years back. If the persistency of 13th month persistency would have been higher, our 48% will also have looked better. I mean, last year our 61st month persistency was close to 60%. So the key for any insurance company is aim for the highest persistency possible, get your 13th month right, it will finally flow through your 61st month number, then work very hard on the 61st month number because there is a 5-year lock-in, and other 61st number, the tendency is that customers do surrender the policies. Work very hard on the 61st month to ensure your 73rd month is sustained. I think that's the way the industry has to look at it. And as I said in the beginning, higher the number, it's a win-win for both customer and obviously the company.